This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the Young Wealth Show, where you'll truly learn how to make, spend, and invest money for an awesome life. Get the real life stuff that wasn't part of your school curriculum. Young Wealth gives you innovative new ways of dealing with your finances, as well as the skills and tools you're going to need to survive and be successful out on your own. Let the Young Wealth Show be your GPS to take you from clueless to clued in. Here's your host, Jason Hartman, with Young Wealth.
It's my pleasure to welcome my friend George Gammon back to the show. I asked him to come on today to talk about the impact of COVID-19, the cerveza sickness, maybe, coronavirus. I know it's not something to laugh about, right, George? But anyway, that'll help us from not getting demonetized. And we want to talk specifically about the concept, which is very rare as an economic malady. You know, I talk about the three economic maladies all the time: inflation, deflation, stagnation. But this one is kind of interesting and nuanced and rare and very disconcerting too, because since we've had the markets really recognize the impact of coronavirus, we are in a position where we are beginning to see a supply-demand shock. And this is a rare malady. So I want to talk about that, but we're going to talk about a bunch of other things. I think we'll go on a lot of tangents today. For you who are only listening on audio, we will also put this on our YouTube channel because George is fantastic with the visuals, with the whiteboard, and we will be showing some of his whiteboard segments here in order to elaborate on what we're discussing. But hopefully it'll come across really well for you if you're just listening to the audio as well. George, welcome back. It's great to have you.
Thanks. I appreciate you inviting me back on. It's always a pleasure to talk.
Yeah, it sure is. And these are scary time. The markets finally, just about a week and a half ago, really started recognizing the impact of this very serious thing. And just to talk about it for a moment before we get into the economic impact, which is significant, and we're going to hopefully impart to our listeners some things that can really help them weather the storm. When it comes to the health impact, I think it's important because so many people are spreading really falsehoods on social media. You know, I look through my Facebook feed, I look through Twitter, and I'm seeing these people saying, you know, what's the big deal? The flu kills more people, blah, blah, blah. That is not true. This is different. There are very important nuances. And since you and I have both been doing a lot of research about it, I just thought I'd let you talk about that a little bit before we jump into the financial side.
Sure. The big difference between the coronavirus, cerveza sickness, whatever you want to call it, and the normal flu, first and foremost is the R Naught value. So the R Naught value is just a scientific way of saying how fast does it spread from one person to a group of people. If one person has the virus and the R Naught value is 4, like it is with the coronavirus, then that one person is going to spread it to 4 people. Mm-hmm. So, and then it just grows exponentially from there. The flu is 1.28.
So less of an
that
issue.
is a huge difference when you get into the exponential growth curve and the math of it. Mm-hmm. And to get a virus to where it just self-extinguishes, you want that R Naught value at 1 or lower. You get it lower than 1 and it's just going to fizzle out because that one person isn't passing it on to enough people in order for it to grow. So that's the first big difference. The second big difference is the serious complication rate. Mm-hmm. So you've got something that grows much faster, call it 4 times faster than the flu. But the amount of people that require a hospital bed are far greater. I've seen some studies, and a lot of people that I have a lot of respect for say that that can be as high as 20%, 20. Mm-hmm. So if you have something that takes 3 months, let's see, not even that, let's say it takes 2 months to go from 0 infections to 1 million infections in the United States, and 20% of those people, call it 200,000, need ICU beds. Well, we've only got 100,000 in the United States.
Right.
So even if the death rate is around 2 or 3%, which is still a lot higher than the flu.
Sure.
But it seems like, okay, this could be manageable. But that's if you've got full capacity in your hospital system.
Right.
If that's strained at all, obviously that 3% is going to go up to 6%, 10%, who knows? And there's places in Italy. And so this is not like a third world Eastern, it's not going to affect us type thing. If you look at Italy, you see several stories of doctors and nurses saying that they're at 200% capacity.
Right.
And it's gotten to the point there where they have to make some very difficult choices. What I mean by that is if you've got two people coming into the hospital, one's 70 years old,
and one's
one
30.
is 40, 30 years old, you're really going to have to decide, okay, we've only got one bed. Who do we send away and potentially let die? And who do we treat? And that's what it's most, unless we get a miracle, which obviously we're all praying for.
I mean, Berlin has some possible good news. Chris Martenson was talking about that. He's been on the show a few times before. There may be, let's all hope for a miracle, but go ahead.
Yeah, if we see the numbers play out in the United States like they've played out in Italy, and unfortunately, because the United States isn't taking this seriously, just going back to what you're saying with all your friends on Facebook or Twitter who just say, it's just the flu, what's the big deal? The flu kills 80,000 people a year and the coronavirus has only killed 100. Right. This is all just media hype. Those people are going to get a rude awakening in about 3 or 4 weeks because, I'm not going to say it's going to happen, but unless we get that miracle, I think it's probably going to play out even worse in the United States than it has in other areas just because we're so nonchalant about it.
Well, and not only that, we're really, America is the land of the land of the free and the land of the rugged individual, right? And Americans don't like being told what to do. They look at it as government oppression and China, I had my friend who lives in China just on the show, as you know, and the one thing you can say about a one-party country that's argue whether it's communist or not, that's debatable in some ways, but it is efficient. They can put the country on lockdown and people are going to listen. Okay. There's only going to be a few outliers, but in a country like the U.S. where everybody's so freedom is drenched in their soul, they're just going to break the quarantine. They're not going to listen if that ever happens, right? And the likelihood of the government doing it is going to be lower here. So there are some times when all this, freedom was great, it works against us, right?
Yeah, there's a downside. Obviously, as a big libertarian myself, I would say the upside's better. But in situations like this...
By the way, I should mention, when George picked me up at the airport in Medellin a couple of weeks ago when I was there, he was wearing a Gadsden flag hat. So that's how libertarian George is, okay?
I go back and forth between that one and the hashtag and the Fed.
and then you also have 2 Ayn Rand hats that I noticed in your house too. Yeah. So exactly. George is a bit of a libertarian for sure. Go ahead.
Yeah. But there is an advantage to that, like you're saying. Yeah. And I think when I mean nonchalant, more specifically, we're not testing, and like South Korea, they did a lot of testing. Singapore has done a ton of testing. And so that, hey, I've got the virus, so I can self-quarantine because you know that your 80-year-old grandmother is much more susceptible, so you're not going to go over there for the Friday night party. Right. Just makes a lot of sense. But if you're not testing, you can't do those things. And going back to the math, that's what brings that R Naught value from 4 or 6 all the way down to 1 where it needs to be. So this thing doesn't go exponential. It's just more linear.
Okay, so the other thing is this virus is tough. It lives outside of the body longer and it's more hardy than other viruses. And it's airborne. So, they say you got to be 6 feet from a person to have a good chance of being protected. You've got to wear eye protection, a mask, and certainly don't touch, don't shake hands. It lives on fabric. It lives on countertops. It lives on doorknobs. If you ever thought about becoming OCD, this is the right time to become OCD. Okay?
Yeah.
So,
not that it's a joke, but I was thinking just Howard Hughes was a little ahead of his time.
He was ahead of his time. Yeah, this is the time to act like crazy old Howard Hughes. Yeah. Okay, so we kind of covered the major health component. Let's jump into the economics.
Sure.
Markets have recognized this. They are scared to death. Events are being canceled all over the world. We postponed our Meet the Masters event. By the way, you were one of the speakers at that event. I hope when we finally do the event, you can still come and speak to our audience.
Sure, for sure.
Event planners, hotels, airlines, cruise ships obviously are really suffering, but there's a whole supply chain around the planet, and China is sort of at the beginning of the supply chain for a lot of products, right? Let's go over this.
Yeah, 94% of the Fortune 1000 companies have part or all of their supply chain coming from China.
Yeah, and many in Wuhan.
Yeah, that whole area, you got it.
Yeah.
You got it. So this is something that can potentially affect worldwide supply chains, meaning that you could have a supply shock. So if you go back through U.S. history, you look at oil embargo in the early 1970s, that was an example of a supply shock.
Right.
If you look at Hurricane Katrina in New Orleans, where you go down to your local store and there's just nothing on the shelves, that's an example of a supply shock. What we're accustomed to in the United States is trying to battle demand shock. Mm-hmm. So we go through the great financial crisis or the global financial crisis, and all of a sudden no one's spending money because no one can get credit. Their main asset, their house, is collapsed in value. Right. So no one's out spending or buying things, but there's still plenty of things on the shelves.
Right. So here's what's interesting about that, George, and you're probably going to allude to this if I don't say it, but we have, the central planners at the Federal Reserve and the government have tools to deal with that shock. They can stimulate, they can do more QE and just push money. They can flood the system with money, and that'll cure some of that because people will just take the money and go spend it, and then that's resolved. But this is a rare dual shock that we're not facing it yet, but it's early. We're going to experience the dual shock, which is has some unique properties, right?
I've never seen anything like this in U.S. history. If you go back to the major economic events, I've never seen a supply and demand shock, a huge one, happen simultaneously. It's not saying that it's 100% guaranteed going to happen, but all the components are in place for it to play out within the next few months. So why demand shock? Well, if everyone is staying in their house because they're afraid of getting sick, if the whole country's on lockdown, like in Italy, no one's going to these conventions. No one's flying. No one's going to Florida for their vacation. They're not out spending money. That's the last thing on their mind. So that's what creates this demand shock. While at the same time, if you look at I had this really cool pictograph that I used in a video last week that showed the top 10 importers from China in the United States. So number one was Walmart. Number two, I believe, was Target. But you had Lowe's, Home Depot, all these big box stores that the majority of Americans go to at least once a week, if not once a day.
Right.
They're getting the majority of their products from China. Okay, well, if China has been in lockdown mode and it takes 30 days to get those goods from China to the United States, there's going to be a big lag there. So we should expect to see supply shocks in the United States within the next month or two.
And we've certainly already, if you want to know how that feels, you got a little taste of it already. And anybody who has gone to any Costco around the country has reported to me and sent me photos of how all the water is gone, all the paper products are gone. I'm not quite sure why the toilet paper thing specifically, but I don't know. I guess that's the ultimate necessity item, that and water maybe. But we've never seen those shelves empty. I went to several stores over the weekend, CVS, Walgreens. I could not find any hand sanitizer. None.
Yeah.
It was, and there were notes on the shelves, yellow notices that said, "We're out. Don't keep looking around the store. Don't ask our people for. We just don't have it." That and the hand sanitizer, the wipes, the water, the paper products. You've seen that. My friend told me he was talking to one of the Costco employees, and they said rice and pasta are the other things. They said when bags of rice come in and they get pallets and pallets of the rice delivered to Costco, they're gone in an hour. Everything's gone.
Yeah. So in that same video, I kind of did this thought experiment on how that plays out. And if we see that come to fruition in the United States, I think you're going to have consumer prices on those items go through the roof. You could see them double, triple, quadruple in price, while at the same time you see prices on higher end items completely collapse. So you see car prices, as an example, completely collapse, while at the same time, price of rice quadruples.
Right.
Yeah, exactly.
Yeah. Okay. Interesting. Okay, take us through a little of this video, if you would. You've got your whiteboard on the screen now. And for those of you listening on audio only, we'll elaborate on this so it'll make sense to you. Go ahead, George.
Okay, so what I did in yesterday's video, which now has 60, 70,000 views, it was really popular, is I went through how the corporate bond market and the credit markets are affected by this crash in oil, by the coronavirus, and by this, call it everything bubble turning into an everything crash. And they all are connected. And I don't think most people realize this. And when it comes, especially when it comes to the corporate bond market, I think people are just whistling by the graveyard. And this is really the center of everything and everything that could go wrong if it gets really bad in the United States. So I kind of outlined what the corporate bond market is, how it works, and why it's so important. So if you're looking at this whiteboard, you see this circle, which is kind of indicating or representative of the market. And you see the line that's, call it, separates the lower 15% from the upper 85%. So below that line is junk credit or high yield credit. That's corporate credit like a Tesla or an Uber. That would be considered high yield or junk because the credit ratings don't give it a triple B. That's the line in the sand between investment grade and high yield.
Okay, which is junk bonds.
Yeah, so that's very important, that line in the sand.
Okay.
In the junk bond market, you've got about 1 trillion, a little over $1 trillion there. Just in the triple B, which is kind of the first step in the investment grade, you've got $4 trillion of corporate debt. So that would include companies like Ford, IBM, Heinz, AT&T, that have really loaded up on corporate debt to buy their own shares back over the past 10 years.
Okay, so let's talk about that for a moment. So a lot of people have been saying that the reason the stock market, or one of the reasons the stock market has just been setting records, and it's just been incredible, is the share buybacks.
Right.
And so companies like AT&T, Ford, Heinz, et cetera, there's a whole bunch more, of course, have been borrowing, they've been doing bonds, right, to buy their shares back, and those bonds, which might have been AAA, are now triple B. And as you go down that ladder, the next step down is high yield or junk bond status.
That's correct.
Okay.
And the big reason that's important to understand, because the pension funds have been supplying the majority of this liquidity or cash to the corporate bond market. So taking it even a step further back, why they've been doing that? Because the Fed dropped interest rates to zero for so long, and these pension funds have to have a 7% return to meet their liabilities. So if you can typically go into a 10-year treasury and get 5 or 6%, well, it's not going to be that hard for that pension fund to meet their obligations. If you can only get 1 or 2% on a 10-year treasury, now you've got real big problems. So the pension fund managers said, well, what do we do? Let's go somewhere where we can get a little bit more yield. Let's go into the corporate bond market. So I want to be clear that was a result of the Fed policy. It was an unintended consequence of what the Fed did. So the pension funds take all this cash, go into the corporate bond market. The corporations, to your point, take that money. What do they do with it? They just buy their own shares back, because it's just this financial engineering where the CEOs can pay themselves more. It looks like their earnings per share goes up, but all they're doing is just borrowing to buy something that gives them a sugar rush. And at some point in time, they've got to pay the fiddler. If their cash flows stay consistent, like with AT&T, then, okay, they might be able to service that debt. Not a big deal. And what most of the bulls point out is that, well, the cost of servicing that debt is extremely low right now because of this low interest rate environment. But what they're not saying is that that debt rolls over. And a lot of these corporations have to roll it over every 2 years, every 5 years. And then they're assuming that their cash flows stay consistent. Well, like you know, and I'm sure a lot of your listeners know, that in a recession or in a depression, the cash flows of these companies plummet. So if you have a situation where the cash flows are plummeting and the stock market is going down, so that's creating this situation where a lot of their debt, meaning those corporations, is getting downgraded into junk, which means the interest rate on that debt goes through the roof.
Like what does through the roof mean? What's the differential there? I mean, of course, it varies by company and such, but give us an idea.
Well, if this plays out, I think it could double easily.
So the debt load or the cost of servicing the debt doubles for these companies.
Yeah, I mean, let's just look at it like a mortgage. I think that's the easiest way to describe it. So you're a real estate investor, and you take out, you're buying a $100,000 home, and you're taking out a mortgage. Let's say your interest rate is 4%, and your monthly payment is X, and after you do all the math, you're $200 cash flow positive. And as your listeners, because they're smart, they take out fixed rate debt, so they don't have to worry about these things.
Right, yeah, right.
but the corporate bond market isn't 30-year fixed rate debt. It rolls over.
The big companies don't have Fannie Mae and Freddie Mac subsidizing their loans. Yeah.
No, they don't. So when that debt rolls over, if it's now, call it 8%, you can imagine what that would do to that positive cash flow that you had in that rental property. Now all of a sudden you're probably cash flow negative.
Yeah, right.
And that's just that's a microcosm of what's going on in the corporate bond market. In addition to that, taking it back to the real estate example, the corporation's cash flow gets slashed. So imagine having a rental property where your interest rate on your mortgage doubles, but your rent goes from $1,000 a month to $400 a month. And that's the situation. And then you take it a step further, and the entire real estate market has been built on real estate investors buying more real estate properties.
Right. Yeah. And what you're doing is you're just making the comparison with the stock market and the large companies that have this debt problem.
I'm not saying that's happening. I'm just using that as an example that most of your listeners can easily understand because they're real estate investors. So if the entire real estate market has been propped up by real estate investors going in and buying these properties because they're cash flow positive, if all those buyers go away, then the real estate market drops, plus the cash flows drop, plus the cost of servicing the debt goes up. You just have this.
And wait a second, though. Before coronavirus, everybody was talking about the everything bubble, okay, and certainly about the stock market bubble specifically. We have out of whack valuations before any of this started, right? With PE ratios in the stratosphere, price to earnings ratios, where the stock market is like a cyclical real estate market. It's like buying in areas that we would never recommend, like, expensive West Coast of the United States markets or expensive Northeastern markets or Miami. These markets they were too expensive to begin with. They had completely out of whack price to earnings ratios, or in real estate we use rent to value ratios. Right. Same idea. And so now you add to it this situation with their financing getting a lot more expensive, and these companies are in trouble.
They absolutely are. But it's not just these companies that are in trouble, because there's a direct correlation between those companies and the overall stock market. And unfortunately, our economy has been so financialized over the past 20 years that now it's the tail wagging the dog.
Sure.
Where the stock market should be a reflection of the economy. Now it's not. It has nothing to do with the economy, but the economy is completely reliant upon the stock market because of demographics, because of the baby boomers having their 401k. They're going to be taking that out. It's all about consumer spending. It's all about confidence. I've been saying this on Twitter and my videos a lot lately, that this whole system is built on confidence. And if that confidence goes, the whole house of cards comes crashing down. Yeah, the main thing to understand with this is the line, the 15% and below is junk debt. The 85% above that line currently is investment grade debt, and the pension funds can only invest in investment grade debt. That's the key takeaway from this picture.
In other words, they're restricted, most of them, not all of them, but most of them, right?
That's right.
Yeah, right. And not to mention, we've profiled it on the show many times, but there's a huge pension problem around the world, not just in the U.S. But yeah, okay, go ahead. Let's move to the next concept here.
Yeah, so to give you kind of a better image of what the corporate bond market looks like, I'm going to go to a graph, which is right here. And the scary part is you can see how much corporate debt we had in 2008, and that, let's call it $3 trillion. Well, now we've got 7.5 trillion, almost 8 trillion.
But this is not adjusted for inflation, right? So I'll give it a little bit of a hedge.
Yeah, this is not adjusted for inflation, but we haven't.
It's still high, but it's not quite as high as it sounds. Okay, so a little bit of okay.
And you've got to look at the triple B market. So this is the gray shaded area. And then the black, pink, and red is the junk market. So you can see how small the junk market is compared to not only investment grade, but triple B more specifically. And the reason I keep harping on triple B, because that's the next step down for them is junk. So moving on to the next whiteboard, this is another example of how it looks and the systemic risks in the system. So instead of a circle, this time I've got the square. We've got the triple B, 4 trillion, the junk at 1 trillion.
So these, we're talking about the bonds here, okay?
Yeah, the corporate bonds. Above the 4 trillion, we've got 2.5, or above the triple B, we've got 2.5. Those pension funds come in, they put in the money just like we talked about, and now I'm putting some numbers to it. So if the pension funds are getting a 4% return by buying this triple B debt, they've got to get that 7%. So there's a big delta there. So what do is they lever up. So if they buy a bond for $1,000, let's say that company gets downgraded, then that bond goes from $1,000 to $500, the face value of that bond. And if they got 50% leverage, well, their equity is completely wiped out, meaning the pension fund. So, and to your earlier point, this is a pension fund that's probably already underfunded by 50%. So this is catastrophic
for retirees.
For retirees, for pension funds, you got it.
Yeah.
Going just over to the right, I show the same squares, but this is if that $4 trillion got downgraded into junk. So now your junk.
So just to help follow. Okay, so the $4 trillion of now BBB bonds get downgraded to junk bonds. Then instead of having $1 trillion in the junk bond market, we've now got $5 trillion in the junk bond market. Okay.
That's right. But the majority of the liquidity can't chase that because remember the pension funds
they're excluded. They can't do
excluded.
Junk.
And that's your main buyer. So if they're excluded, you've got $4 trillion of supply coming into a market that only has $1 trillion of liquidity. That's why I say that it wouldn't surprise me at all if the interest rates in that junk market just doubled almost immediately. So then you say, okay, George, this sounds a little extreme. How would that $4 trillion go in all not that it would at the same time, but how would the majority of that be labeled as junk? Well, you've got to look at what's going on with the coronavirus. You've got to look at what's going on with oil. We didn't discuss that, but a good slice of that $4 trillion, oil corporations. So if oil corporations have to deal with $25 oil, especially in the United States, they're not going to be able to pay their debts.
Yeah.
So that's how a lot of that goes down to junk. Also, because
we should elaborate on the oil thing because that's a huge deal. That's hugely important.
Huge.
Yeah.
Massive.
Okay. But go ahead. Yeah.
So that's why a lot of those oil companies could not only go out of business, but at a best case, get downgraded. And then we go back to the Ford, the Heinz, all these non-oil companies, but that are floating right on the cusp. Well, if the stock market goes down because of the coronavirus, that means the asset side of their balance sheet also goes down, but the debt stays the same. That's when Moody's comes in, or what ratings agency XYZ, and says, okay, AT&T, there's no way that you can service your debt, or you can't service your debt as easily as you could prior to this recession because your cash flow isn't there, your assets have gone down, your debt's still the same, or it might even be at a higher interest rate.
But George, Moody's can just do what they did prior to the Great Recession. They can just lie about the ratings.
I know. And I don't know if anyone noticed. Yeah. In fact, maybe I should go back. Let me go back to this slide really quick. I know you'll get a kick out of it. Yeah. It's kind of cheesy humor, but this is kind of the way I do my videos. You can, for the people who can see the video image, you can see I've got this stick figure, which I use in a lot of my videos. This
little person, he's got your family member Fred or whatever.
Well, this guy, you can see he's cross-eyed. Yeah. He's got kind of a twisted smile. He's actually holding a bottle of whiskey, and his hat is M. And in the video, I look at the camera, I say, well, what do you think that stands for? Let's pretend it stands for Moody's.
Mm-hmm. Oh, yeah, Moody's, the rating agency. Yeah, they're drunk on their whiskey.
All
right?
the time. Yeah. That's right. Yeah. You got it. You got it. So to your point, it does rely on Moody's, who is drunk half the time. So, but assuming that downgrade happens with your oil, your AT&T, your Ford, that's how I'm getting that $4 trillion going from the BBB market into the junk debt market. So you've got the interest rates explode. Mm-hmm. And how does that affect the corporations? Well, we talked about how it affects the corporations that are moving into the junk status, but let's not forget the junk corporations that are already there. So first and foremost, a company like Tesla. Okay, well, yes, they have had a bump in their share price, but now it's going back down. But sooner or later, a company like Tesla or Uber who incinerates cash is going to have to go back, and they're going to have to go and sell more bonds. They're going to have to sell equity in order to generate the cash they need to sustain themselves, especially if we go into a recession. If they're able to borrow right now at 4 or 5% and their borrowing costs go up to 10%, they're done. They're done unless they have some sort of miracle, which could happen. But the probability is that they go out of business as well, which puts more pressure on the stock market.
The funny, I got to just mention on Tesla, Tesla is built on a house of financial engineering beyond comprehension. I don't know how they did it. I don't know how they had that recent run in their stock. I just don't get it. Don't get it. And yesterday I discovered a Twitter profile. I think it might be Event Horizon or something as the handle. And he said, preparing for the criminal trial of Elon Musk.
Yeah.
I mean, there's so much financial engineering in that company. I just have no idea what's going on. But yeah. And what's interesting about it is you mentioned, and I think this was before we started recording, we talked for about 20 minutes before we started. I'm not sure this got on the show, is that with the oil price collapse and maybe even a further collapse in oil prices, of course, that means there's not going to be any shale oil industry, because it's just too expensive, and there's going to be a lot less production. So you may come into a future supply-demand shock, but not in the foreseeable future. But you talk about the green energy companies and how they just won't get any funding because their business model only works if oil is expensive. And even then, it's questionable.
Yeah, I'd take it a step further and say their business model only works when we have very loose credit markets and we've got really cheap money.
And we've got the government acting as a venture capitalist or giving handouts, which they should not do, like Solyndra and Tesla. Solyndra's gone, Tesla's still in business. If we get someone like AOC and her crazy Green New Deal, I mean, you've got the government picking winners and losers. The government's in the venture capital business, right?
Well,
it's crazy. It makes no sense to me. But
who knows what they'll do if they'll do something like that. Yeah. Again, I'm not sure. Yeah. But
I'm not saying I agree with any of it. I think it's ridiculous.
No, I know. Yeah. No, I know. Yeah. But if they stay out of the market, then it's those companies. The green energy companies are in a very similar position to Tesla, that they don't make a lot of money, if any money at all. Sooner or later, they're going to have to go back to the capital markets. Right. And if there's no money for them, then they're out of business. So you get this situation where a lot of the oil supply is going offline or potentially will go offline because of shale. You get tight money in the corporate bond market, and you've got the credit markets collapsing. So the green energy companies can't be as competitive, so they're not as much of a threat to oil.
Right.
And it goes back to the old saying where the cure for low prices are low prices, especially in the commodities space. So I'm not here to say whether green energy is good or bad or oil is good or bad. I am here to say that from my vantage point, the 5-year or 10-year outlook for oil, if this plays out, could be very good.
Yeah, very interesting. But it's probably going to get a little cheaper first. We might actually start giving some stock tips on this show. Even though we love real estate, we love income property. So that's kind of anathema.
But everything is a function of price.
Right, absolutely. No question about it.
Cash flow, whether it's the mortgage, whether it's a real estate property or a dividend-paying stock. And so many people accuse me of being bearish on the stock market, but that's not really true. I was bearish on the price of the stock market. If I can get the stock market at a 80% discount, well, then I might not be so bearish.
Even me, who, commandment number 3, thou shalt maintain control, which I don't like having middlemen in my investments. I don't like, being subject to the graft and corruption of a fund manager, an investment bank, a CEO, a board of directors, because they're skimming all the profits off the top. But when the discount's big enough, you really mitigate that problem quite a bit. So I agree. I'm an opportunistic investor. So yeah. Okay.
Yeah. And I want to go back to the right-hand portion or on my right. And because I think there's a couple things that most people don't think about. So even if they've heard about the corporate bond market and they understand the tie between that and the stock market, I think they're not taking it another step, which I'd suggest. And that's to understand that these pension funds are going to be in deep, deep trouble. So what are they going to do most likely? And these pension funds, we're talking about state pension funds. Well, they're going to try to raise taxes. So they go in with property taxes. They go in with a VAT, a sales, who knows? They're going to try to take every last penny that you have. And they're probably going to have to do that in a time where the United States is going into recession. So that's why I've got it written up on the board here. What that means is what presents another really big problem in the sense that during a recession, tax receipts plummet.
Right.
Tax receipts really, I know it sounds crazy to say this, but they don't have a lot to do with tax rates, believe it or not.
Right. Oh, yeah. Well, my listeners already agree with that concept, mostly because, that the point, if you want to collect more taxes and you're the government, you need to expand the economy. You need to grow the pie. You need to increase the size of the pool. And the way you do that is by not intervening too much and not being too greedy. The pie gets bigger, okay? And then you get more revenue. That's what Reagan really proved. And remember, Reagan, looking back on history, he did not have the benefit of the fax machine or the internet increasing the velocity of money and expanding the size of global markets. He didn't have the benefit of globalization, really. I mean, most of this stuff that really lent a big powerhouse to the economy was post-Reagan, or at least at the very end of his term. I don't know if you agree with that. I'd love to hear what you think of it, by the way. But most people don't recognize the internet and the fax machine as any big deal. I think it's huge.
Yeah, what most people get wrong about Reagan is they always say that he had a revenue problem. He didn't have a revenue problem. He had a spending problem.
Yeah.
And another thing I'd point out about Reagan is that, keep in mind, the interest rates on government debt during the time of Reagan, I don't know the exact numbers, but I would be willing to assume they were well north of 10% because of what Volcker had to do. And a lot of the debt is short term that the government has to roll over every 2 years or so. You compare that to an interest rate on the national debt of $23 trillion of maybe 2%. So although yes, Reagan did have a spending problem, he also had a problem of the amount of interest he was paying on the national debt was much, much greater than it is today. But going back
But one more thing about Reagan. Reagan had a business plan for his spending, okay? His business plan was to bankrupt the Soviet Union, and that was achieved. I mean, listen, history can argue with this. People have different opinions. But that was a business plan. There was a finality to that actually, you could argue in the long run, saved money because it ended the arms race to a large extent. There's no business plan for the welfare state. Okay, government handouts is not a business plan. It doesn't make people independent. That's been proven over and over. So I don't know. We can argue about this till the cows come home.
No, I totally agree that the way that we're spending money is counterproductive.
It's not investment grade spending. Okay,
yeah, exactly. You're not going to get a money multiplier on it. Right. But going back, the key thing there, Reagan dropped rates to call it 25%. But if you look at tax receipts as a percentage of GDP, they were just as high as they were back in the 1950s, when all the Krugmans of the world say that we lived in this nirvana because the tax receipts were so high. That is a complete fallacy.
Yeah, well, Paul Krugman doesn't know what he's talking about. But
yeah, the percentage of the receipts as a percentage of GDP were very similar in 1950 to where they were in the 1980s. They really don't change too much if you look at a chart. So my point is that what really affects tax revenues, though, as a percentage of GDP, is the stock market and recessions. So if we go into another recession, and in my opinion, if we do, it'll be worse than 2008 because the debt is so much higher. That means the taxpayer is not going to be able to fund these pensions. So this feedback loop that we've been talking about gets even worse. And to take it to the next step, you got to look at all these baby boomers who have been retiring, and they're taking money out of the stock market. And if we go into this negative interest rate environment, they're going to have to save even more money.
Their retirement standard
less.
of living will be nowhere near what they expected. So there's going to be
not even close, but they'll be spending a lot less. And if you look at demographics, I think you just had Harry Dent on the other day, but the U.S. economy has gotten a lot of the tailwind or the headwind from the baby boomer generation.
Sure.
Whether it's the spending, whether it's their investment habits.
They changed the world as they were moving through the economy. The baby boomers, more than any other demographic cohort, just changed the whole world. Yeah.
Right. So now you've got that massive glut of people that would normally be reducing their spending habits because they're going into retirement. Now they're going to be reducing their spending habits 10x. Because of the pension funds, negative interest rates, they can't get a return on their money. Then if you look at consumer spending being 70% of the U.S. GDP, that's why I called this segment the Doom Vortex, because that's what I call this feedback loop.
It's a feedback loop. That's a very good way to look at it. No question about it. Okay, so you invest in all kinds of stuff. You like real estate. You like income property, as do I. I think it's the best thing going. I can really only see two strategies for this. I think the cheap income properties that are necessity housing are great. All you have to do is people just got to pay their rent. Regardless of what values do, we invest for yield. So, we don't care about values too much. Hey, listen, we're happy as a clam if they appreciate, but we're not expecting that. We're investing for yield. So if people will just pay their rent and we can maintain our expense ratio, we're in good shape.
So I think it's really important to point out right now for people who are considering purchasing in this market that's kind of up and down.
Right.
I think if I was buying right now, and I'd love your feedback on this, I'd be really trying to focus on really good neighborhoods where I'm getting a very quality renter that can most likely survive a downturn in the economy.
Yeah, and our rents held up surprisingly well during the Great Recession. It wasn't perfect by any means. That was the worst economy in 7 decades, for God's sake. But it was surprisingly good, actually. They showed a surprising amount of strength. But you always have to ask yourself, compared to what? Like, what else are you going to do? So the second thing I was going to mention, and listen, I'm not a precious metals bug. I own some of it in some of my businesses, but, gold is doing pretty well. It's the fear trade, right? What do you think about the metals? I just want to bring that to the fore again. And then maybe some stock tips even when things really collapse, if it continues to decline like this.
How much time do you have?
Well, not much, but...
Not much? Okay. Because gold is, I could go into the repo market, repo fails, the oversubscribed, because that really ties into gold if you go back to 2008. First and foremost, I want to say the way I like to do it is I compartmentalize my portfolio into 3 categories. 1, insurance, 2, investments, 3, speculation.
Right.
So only insurance for me is gold, and that's only 10% at a max of my portfolio. That just is, I want to maintain.
I think that's reasonable. And is it just gold, or do you like any of the other metals? One of my companies had quite a bit of palladium, and when I say quite a bit, I'm talking not that much really in the broad scheme of things, not compared to the real estate and stuff like that. But, that went through the roof. I was so surprised, that did so well.
I like a lot of the metals. I like the miners, but I just don't put them in the same category. To me, they're not insurance, they're a speculation.
Oh, got it. Okay, so you do the 80, 10, and 10 strategy. And so 10% is insurance, which means gold, and 10% is speculative, just a bunch of speculation stuff.
And the way I define that is I'm just betting on the price going up or down. And then the 80% is investment. The way I define that is it has to pay me to own it. And so
like
obviously real estate's you got it. You got it.
Yeah. So income property, and you only like the linear markets, unless you're doing a flip in Colombia where you live. But otherwise, it's linear market investing, just like my strategy, right?
100%.
Yeah. Okay. Good stuff. You can find George on YouTube. He's got a great YouTube channel. I've been on it a few times, and he just does a really good job educating people. Obviously, I think all our listeners and viewers can see that today. So, George, thank you very much. Any final comment?
No, I just want to make sure that the Americans that are listening to this, and I know you've got a worldwide audience, but specifically for the Americans, that they're not putting their heads in the sand.
Yeah.
And I'm not saying that you should be worried, that you should lose sleep, but I'm just saying pay attention to what's going on with the economy, what's going on with oil, what's going on with the repo market, what's going on with the coronavirus. And just be prepared. And what's your downside to doing that?
Yeah, not much downside. Be prepared. I have my holistic survival show. You can be prepared for very little money in terms of preparation. And wash your hands and stop shaking hands. The handshake, maybe one of the silver linings that will come out of this is the handshake needs to just go away. I mean, it feels kind of weird when you meet people and you don't shake their hand, but, maybe we should just bow like the Japanese, it's very polite, or, the elbow bump or something. I don't know. But the handshake is, they say the mosquito has been the biggest killer of humans in history. The mosquito, the little humble mosquito, right? Because it spreads disease. I'd say handshake might be number 2. Yeah. All right, George. Thanks for joining us.
Yeah, no problem.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.